Hey, welcome back. And as we head into tax season, a lot of us are going to be forced to go look at this muddy, messy thing called taxes. Yes, dread it, fear it, run from it. It all comes the same, that April 15th deadline. Now, there's a lot of different ways that taxes work for a lot of different people, depending if they're, natural human being versus an entity that's not alive. And, is this a trust? Is it an estate? There's a lot of different ways to do taxes. So I will just focus on to the 1040 for this particular installment of this episode. And we're just going to be going over, general things to kind of look at and whether or not this is prudent for you. Once again, this is educational. And if you feel like something is missing on your tax return or is you have further questions on, definitely reach out to your tax advisor, talk to them. You should feel comfortable with what's being filed. At the end of the day, this is a document going to government agencies with your information on your behalf. So if you're not comfortable with filing that return, don't sign on until you are comfortable. And if your advisor is making you feel uncomfortable about positions that are being made, then maybe you should go talk to another advisor. But nonetheless, that's neither here nor there. I have on the screen over here, this is going to be Form 1040. It's not going to be the 1040 SR. And because this is in the beginning of the year, there are still forms in development. So my tax filing software is going to just have this nice little watermark over here. But when you guys go to file, you're not going to have to go deal with that. So for 2025, this top part up here is just really your sensitive information on, who you are, your social security number, where you live, and whether or not you were actually in the US for more than half the year, if you want anything to go to the presidential campaign. Most of this doesn't really get used. However, when someone dies, you have to file your tax return. It's important that, we get that deceased box over here marked. And that way, it says, hey, this is our final year tax return for that particular individual. Or if it's, it's a spouse. If you are living abroad, then, maybe we have to, list out your foreign country or where it's at. But for most people, let's just say you're going to be in continental US. And that's kind of this top part right up here. Going into the second area, the middle, we're going to say whether or not, which kind of filing status. Whether or not you're single, married filing jointly, filing separately, non-resident aliens as NRAs. We have a head of household and qualifying spouse. This one's really important, this digital asset one, and it's becoming more and more prevalent with the IRS as they try to really crack down on all the crypto kids out there. So, what does it say? At any time during 2025, did you receive as an award, a payment for services? Did you sell, exchange, or otherwise dispose of a digital asset or financial interest in a digital asset? Yes or no? Now, why is this important? Because if you mark no and you did, then congrats. They can get you for tax fraud. Now with the IRS, there is statute of limitations. And it's really hard for them to prove tax fraud because they have to prove what's called intent. And there's things that have to go into that. And if you're actively marking no when this should be a yes, then the statute of limitations does not apply to you. Keep in mind, Capone was caught by the IRS, not the FBI. So, for you crypto kids out there and are trying to hide your assets from the IRS and you're marking no, then you're keeping that door open for them to come back. The statute of limitations, once you file, as long as everything is done with not having willful neglect or active tax evasion, statute of limitations for most people is 3 years for them to come back there and question it. So just be honest. Did I do this? Yeah, okay, then I'm gonna mark yes. And that way, they can't come back here and open up Pandora's box 20 years ago because it turns out I marked no and I sold some Bitcoin this year. My bad. But this is them trying to give you a gun to shoot yourself in the foot. So do not gloss over this. Be honest. Second part in the middle is going to be our dependents. Who do we have? We have child sample over here, social security number, their relationship to the taxpayer, if they lived in the US more than half the year, and what credits are they qualifying for. The reason why they're looking more into this is they're trying to disallow people who are claiming credits that they're not supposed to be getting. So they're trying to really hone into this. Make sure, double check when you get ready to file that your social security numbers are right and that these children are being added. Because let's say, for example, you forget you have 4 children and the 5th one isn't shown right here, and you forget to check that it's there, and you file that tax return, you're not going to get that child tax credit. They're going to disallow. You go back to the IRS like, oh, I need to amend for this, and the IRS will tell you, tough luck. The buck stops there. And then you can threaten to go take them to tax court, and they'll welcome you. And that's just more time, drag on resources. You don't want that. So the best practice is always making sure that we check our dependents' names, social security numbers, relationship, and we're claiming the applicable credits for them. This last box down over here is for those, MSS, that's going to be married filing separate, or HOH, that's going to be your head of households. And if you're dealing with a community property law state, this is going to be really applicable for you, because if you're out of there for like 6 months, you don't have to worry about this thing called community property laws that are going to say half of this person's assets and income and deductions are on yours. If you file separately, then you need to make sure this lines up there. After 6 months of being separated, not living with them, then you don't have to worry about that community property law issue. Moving into the fun stuff though, the numbers. This is all going to lead up to our income. This first page is all about just where do we get our money? Where does it come from? So then our top line is going to be our wages, because unless you're retired, that's going to be your main source of income. Why are we filing taxes? That's because we had some kind of taxable event go on, and that's probably going to come from our wages. So that's W-2. You're a household employee, you have tips, Medicare waiver payment. All this extra fun stuff is really new coming out of OBBBA, but still important. But for most people, they're not going to really see boxes 1B through 1H. Most of us are going to see 1A for sure. And then 1Z over here is just a sum total of what happened in these other boxes. Now, we can earn income multitudes of different ways. For this particular area, we have interest, dividends, we have our retirement distributions, pensions, social security, lots of fun stuff, and then our investment capital gains. All this stuff is going to give us another source of income. Our retirees are going to be more common to go see, this information built out. For us still in our working years, we'll have interest and dividends, capital gains if we're invested into the market. If not, then, you're not going to see that. And Social Security, IRAs, and pensions are really for those who are retired. These other boxes over here, we're going to see is what is applicable for taxable income and might not be applicable for that ordinary income tax. Like, for example, tax exempt interest, what's going to be taxable interest, qualified dividends. That means it's that qualified rate, which is going to be tax preferred versus ordinary income tax rates. What was non-taxable portion versus a taxable amount of our IRAs. Same thing goes down here. Now, getting us all the way through here, then, you're going to have your Schedule 1. In this particular, sample client I have over here, I just went ahead and created him a business. He got $50,000 of gross receipts. He has some minor deductions, and his net profit was $49,000. This will ultimately carry over to our Schedule 1. Our Schedule 1 is going to have some income, and it's going to have some deductions. I also had some unemployment from him, because he had wages. Maybe he lost his job and he's trying to get his business up and running. So, he had a 1099-G, and I just kind of put that in there. So that gives us $59,000. And then he actually had the deductible portion of his self-employment taxes at $3,462. But this really kind of will feed over back to our 1040. So we see that $59,000. That $59,000 plus the $36,000 is going to give us $95,000. Going back to the Schedule 1, his deductions he had from there was $3,462. So that's going to reduce the $95,000 by this corresponding amount and give us what's our AGI, which a lot of you might be familiar with. And this is a fun number for a lot of people looking for get houses and whatnot. So our AGI, $91,538. Based on that, we had some other deductions that are going to help reduce this. So we don't get taxed on our AGI, but it is a nice little starting point for us in the tax calculation. Our AGI will be reduced for our standard deduction or itemized. For Gary's sample over here, He took the standard. That was going to be $23,625 for a head of household. Then because he had his business startup, he got the QBI, the qualified business deduction. That was for $9,108. So if you add these two values up, we're going to get $32,733. This now amount will reduce our AGI at $91,000 by its corresponding amount and give us what's called taxable income. Congrats. This is where your taxes come on. It's not that I was getting taxed on $95,000. I'm getting taxed on this $58,000. The taxes on this are $6,700. Great, I have a child tax credit. That's going to reduce it by that corresponding amount. So now I'm looking at about $4,500 in taxes. But wait, it gets better. I had a business, and because I have a business, that means I have to pay self-employment taxes. That's going your FICA, your FUTA. That's you going to pay into Social Security and Medicare. That's 15.3%. And in doing so, he's got $6,923. He's going to take half of that as a deduction. We saw that on the Schedule 1, but this tax will come back to the 1040. This tax is seen right over here. So even though he had his ordinary income tax of $4,500, we have to add that $6,900 in it. So his federal total tax for the year was $11,442. His W-2, he withheld $3,600. And because he was working with a savvy tax advisor, he kind of let him know like, hey, taxes are coming. And it looks like he withheld on his estimated taxes just enough to kind of try to cover what his self-employment taxes would be. So ultimately, his total payments, his credit towards the total tax was $10,160. So the delta between this total tax and your total payments, it will either be a plus or a minus. And if it's a plus, you get a refund. If it's a minus, you owe. In his particular case, he owed. So he has to pony up $1,282. And depending on how things may work, he might have an estimated tax penalty in which, we would see that down here. There's a lot of different forms that go into your tax preparation, and not all of them as straightforward as the 1040, but just having a base understanding of how your 1040 works is always good to know. And this is for educational purposes. And if you have any questions, go talk to your advisor. And if you're not working with an advisor and you want to get to know more, go talk to your local tax professional. Thank you for tuning in. You have a great day.